right? So we are going to discuss past papers relating to the financial instrument, which is going to cover LKS 32, 39, SLFRS 7 and SLFRS 9. First, we are starting with June 2016, question number 4. So you can read June 2015 question number 4, right? This is the question number 4. Alankara PLC recently had the following transactions. First one is a newly constructed building was leased out to another company for a period of 3 years for a monthly rental of rupees 200,000. That is the first one. Second one, 200,000 redeemable preference shares were issued at rupees 50 each. Cumulative dividend is paid at 10%. Third one, Alankara granted an interest-free loan of rupees 2.5 million to its subsidiary company, Rainbow Private Limited. The loan is payable in 5 years. Fourth one, an additional tax liability of rupees 1.2 million is to be paid for the year of assessment 2013-14 as assessed by the Inland Revenue Department. Alankara recognized a liability as at 31st March 2016 in this regard. Explain whether each of these items stated in 1 to 4 above should be classified as financial assets or financial liabilities in the statement of financial position of Alankara PLC. Right now, what you want to do is you want to classify whether this is a financial asset or financial liability with the reason why you classified so, right? Okay, we'll look at the first one. Tell me the first one. A newly constructed building lease out to another company. Now we know when we start the financial instrument lesson, first of all we define what is a financial instrument. So there we identify financial instrument is any contract that gives rise to a financial asset of one party, entity, and a financial liability or equity instrument of another entity. That's how we define financial instrument in broader. Then we identify there are 3 main categories under this. The first one is financial asset, second one is financial liability, and third one was equity instrument. So based on that definition, now you should identify whether the first one, second one, third one, and fourth one can be classified as either of these 4, whether it's a financial asset or whether it's a financial liability, right? So you want to tell. That is the requirement. First one, or rather first one, if we have any doubt in the first one, shall we look at the second one? 200,000 redeemable preference shares were issued at 50 each. Cumulative dividend is paid at 10%. So here you can see now Alankara PLC, they are the one who has issued these redeemable preference shares, right? By the time they issuing these shares, these are redeemable preference shares. In particular time, they need to pay that back. So you call it as redeemable preference shares. As of today, you have a contractual obligation, isn't it? You have a contractual obligation to settle this, right? Deliver cash or another financial asset of your Alankara PSC, right? So there is a obligation to deliver cash because we have issued shares, preference shares. These are redeemable preference shares. In particular time, we need to pay it back to them. So today we have a present obligation, deliver or contractual obligation, rather present obligation. You have to use the word contractual obligation because there should be a contract. Therefore, this must be classified as a financial liability. That is the second one. Third one, Alankara granted an interest-free loan of rupees 2.5 million to its subsidiary company Rainbow Private Limited. The loan is repayable at 5 years. They have given a loan, intercompany loan to one of its subsidiary. Right? They have granted this as an interest-free loan. What do you think? They have granted this. Is it a financial asset or a financial liability? We discussed about this during our session also, theory session, because thereby I explain you why property, plant and equipment is not become a financial instrument. The reason is, in a property, plant and equipment, it can bring you future economic benefits, but there is no contract between company and the property, plant and equipment to deliver cash or something. There is no contract. So therefore, we are not recognizing that as a financial asset. But remember here what happened? They have given an interest-free loan to their related party company. They are going to repayable that is loan after 5 years. So you have to recognize that as a financial asset. The reason is, here Alankara has a contractual right to receive the cash that we discussed, right? Under the definition of the asset, they have contractual right to receive cash in future after 5 years, because even though it is an interest-free loan, they are receiving these cash after 5 years. So you have to recognize this as a amortized cost financial asset. Amortized cost financial asset. Okay, come to the fourth one. An additional tax liability of 1.2 million is to be paid for the year of assessment 2013-14 as assessed by Inland Revenue Department. What happened? The Inland Revenue Department say that for the previous year you have made underpayment of taxes. This year you need to pay that underpayment relevant to the year 13-14. Will that be a financial asset or a financial liability? Will that comes under the definition of a financial instrument in broader concept? No. Why? There is no any contractual obligation. There is no contract between us and the Department of Inland Revenue, but it is a legal obligation, or we can say it is a statutory obligation arise. There is no any contract. නේ අපි contract එකක් ගහලා තියෙනවද department එකත් එක්ක? No, there is no such. Therefore, this is not a financial liability, rather this you have to recognize as a provision, a general liability in the financial state. So this is not. Right, we discussed three things. Now we'll go and see what is the answer for the first one. A newly constructed building was leased out to another company for a period of 3 years for a monthly rental of 200,000. What do you think? Is there any contractual agreement? Normally, yes. Why? Because they are supposed to pay. They will ask more money. Neither. Right. So here, what you want to do is a newly constructed building, right? So we have leased out. We have leased out in the sense, Alankara has a responsibility, commitment to give them the space of the building for them to use, right? But for that purpose, they will receive a consideration. That is not a financial liability. That is because they are providing this as their normal service. කියන්නේ යාගේ main service එකේ part එකක් විදිහට තමයි they have rented this building out. So this is part of the service. It is not a contractual obligation, right? They want to give the space of the building to the other party, and the other party need to pay for that. That is in their business transaction. It is not a financial arrangement. So you should not classify that as a financial asset or a financial liability. But remember, once this lease rental is going to be due, then there will be a liability. There will be asset. It will be a financial asset. The reason is, now before we due particular rental, due rental in the sense we are supposed to get that, right? Before that, it won't be a financial asset, but after due, it will be a financial asset. So you have to consider 2, 3 as financial, 2 as financial liability, 3 as a financial asset. 4 is not a financial liability, it is a statutory liability. And first one is also not a financial asset, but once the lease rental is due, it becomes a asset. It becomes as an asset. Done. So we've done the first part. Right. We'll move to the part 2 of the question. Right, part 2 of the question. Read the part 2 of the question. On 1st January 2016, Alankara PLC purchased 100,000 shares of another entity listed on the Colombo Stock Exchange. The management does not intend to trade these shares. That word is important, neither. What they are saying is, they do not intend to, right? They don't have any intention to, does not intend to trade these shares. So that their intention is not to trade these shares, their intention is to keep the share for a long period of time. Now we know, as per the classification, when it comes to shares, right, when it comes to shares, or we can call it as the equity, right, when it comes to shares or the equity, we divided equity mainly into 2 parts, one called fair value through profit or loss, the other one we call fair value through OCI. Fair value through OCI. If you are purchasing some shares for the purpose of trade in the short-term market, we call them as fair value through profit or loss. If you are purchasing shares to hold such shares for a longer period of time, for strategic purpose or for capital appreciation purpose or to get dividends for a long period of time, we classify them under the fair value through OCI financial assets. Right. That's what the theory we learned. So now you can identify their intention is not also not to trade in the short-term market. then they would have taken this to what purpose? Keep it for a long period of time, right? Keep it for a long period of time. Keep this for a long period of time, right? So in that case, you want to classify them as fair value through OCI. So we learned how to recognize fair value through OCI financial assets, right? Now we'll see. Right. The following expenses were incurred on the date of purchase. Price paid per share 50 rupee, commission on purchase 50,000. The quoted price per share at 31st March 2016 was 60. If Alankara intend to sell the investment, it has to be incur a cost of 30,000. Part 1. Calculate the fair value gain or loss arising on subsequent measurement of the investment at 31st March 2016. Second one. Instead of investing in quoted shares, assume that Alankara made the available investment in non-quoted shares and the same was classified as, you want to change this, this is the previous paper, so you want to classify this as fair value through OCI. Right, it has to be fair value through OCI, right? So there are two questions. First one is calculate the fair value gain or loss arising on the subsequent measurement. That's the first part, right? So shall we calculate it? Okay. Now we identified this as a fair value through OCI financial instrument, right? Fair value through OCI financial asset, right? This is a fair value through OCI financial asset. Okay, fair value through OCI financial asset. Now, we know that when we recognize it initially, you know how much is the purchase price. Purchase price, how much is the purchase price? They have paid, they have purchased 100,000 shares and paid 50 rupee per share, right? So 100,000 shares multiplied by 50 rupee, that initial comes 5 million rupees, right? Initial comes 5 million rupees. That is done. Then there is a commission on the purchase. Now we know that if a financial asset is classified as fair value through OCI, what we should do for this transaction cost, the transaction cost should be added. So what you are doing is you take the commission cost, you add this 50,000. Now your initial measurement amount will be 5 million and 50,000. Right, 5 million and 50,000. That is the initial cost. 5 million and 50,000. Then the quoted price per share as at 31st March 2016 was 60. If Alankara intend to sell the investment, it has to incur 30,000. So here, when you are getting the the fair value at the end of the period, or else you can say the fair value of the investment as at 31st, because you know subsequently also you measured that financial asset at the fair value. So you can take fair value of investment as at 31st March 2016. So that is going to be how much? You have 100,000 shares. The share price of per share will be 60 rupees. Then this balance will be 6 million. Therefore, you can calculate fair value gain. How much is the fair value gain? It becomes 950,000. 950,000. How you got the 950,000? You compare initial measurement fair value and the subsequent measurement fair value. This 950,000 where you want to recognize that is in the other comprehensive income. So, right? So part 1 of the question asks, calculate the fair value gain or loss arising on subsequent measurement for the investment asset 31st March 2016. So we calculated, this is the answer, the fair value gain is 950,000. Done. Second one, instead of investing in quoted shares, assume that Alankara made the investment in non-quoted shares. Now you can see in this example, they have purchased this listed company shares, right? Listed share from a company which is listed in the Colombo Stock Exchange. When it comes to these listed shares, you know that you can get the market value for the same, right? You can get the market value for those shares because readily available market is there. But remember, the question asks, if this company has invested these shares in non-quoted market shares. In අපි හිතමු යාළුවෙක්ගේ private company එකක shares අරගන්න. අන්න ඒ වගේ දෙයක් වුණොත්. Right? It's not a quoted, it's just a private limited company shares rather than taking these non-quoting shares, quoted shares. Right? If that is the case, the question asks, instead of investing in quoted shares, assume Alankara made investment in non-quoted shares and the same was classified as fair value through OCI. Assess the impact of the decision on the subsequent measurement of the fair value through OCI financial instrument. Fair value through OCI. Fair value through OCI. Understood? Right. So, can you remember we discussed under the when we are discussing the fair value standard, right? When we are discussing the fair value standard, we discussed what are the ways that you can calculate the fair value, right? What are the approaches that you can use to calculate the fair value? We discussed about that. What are the approaches you can go? The first one is the market approach. Second one was cost approach. Or else we can go with income approach. Standard recommends to go with this market approach. But in the absence of market approach, now the same example what we are discussing right now, Alankara PLC has, as per the example, they have they have invested in the quoted shares, but it asks what will happen if they invest in non-quoted shares. How you can get the fair value? We've learned that, right? By using these alternative methods, either cost method or the cost approach, or else the income approach, alternate by using those kind of alternative valuation method, entity can measure a value for these shares as at the reporting date, right? Then those resulting gains you can recognize in the other comprehensive income. Because there is no any active market prices, so what you can do is you can use different techniques given in the standard for the fair value, and that fair value need to be taken. So that's why you have to take. Using a different fair value valuation method, you want to calculate how much is the fair value, and accordingly taken that into the account. Clear? Right. So that is the answer for that question. So we have done this question number 4. Right. Then we'll move to the question number December 2016 question. December 2016 question. December 2016 question. Question number 3A. No, we'll skip this for the time being. We'll do this little later, then because there's some impairment adjustment also. Then we'll go with this question number June 17, Aj. June 17. June 17. Question number 3. Right, this one. June 2017, question number 3. On 1st April 2016, J Private Limited lent 10 million on to K for 5 years. The loan carries no interest, but J expects the other future economic benefits such as receipt of the goods or services at favorable prices. On the initial recognition, the market rate of interest for similar 5-year loan with payment of interest at maturity was 10% per year. The loan is repayable at the end of 5 years by K. The financial year end of J is 31st March. Required to advise the management of J on the initial recognition and subsequent measurement as at 31st March 2017 of the above transaction in their books of accounts. So now you want to calculate how we are going to recognize this in the financial statements. Right, you can see now the example which we discussed in the class may have some interest, coupon interest, and they will have some face values, but here there is nothing. But we have discussed this. So what happened here? First of all, tell me what sort of a financial instrument this is. Is it equity or debt? It is debt. Under debt, we identify there are 3 classifications, 3 categories. One is fair value through P&L, the other one is fair value through OCI, the other one was amortized cost. Out of these 3 debt categories, into which bucket you can put this investment? This is a loan. There is no interest, but at the end of the period, they are going to repay the loan. which means you are expecting to get this proceed on its maturity. You are keeping that until it get mature. So your business model test is satisfied. At maturity, even though you are not getting interest, you are getting the capital you invested. The second test is also satisfied. So you need to classify them as amortized cost. We learned how initially should recognize the amortized cost and subsequently we should recognize. Right? So initially, whatever a financial asset, we should recognize using fair value. Now you need to get a fair value for this loan. Now you can see J company has given 10 million to K. J has given 10 million to K and agreed by K to repay this loan after 5 years. Right? Which means after 5 years I am receiving the money but no interest. Can you imagine a company is giving loan with no interest? Is it that at the fair value? No, it is not at the fair value. Why? You know, normally when you are taking a loan, you need to pay interest for the period where you retain that loan with you. In this case, this J company has given this loan to K without getting any interest, which means you can't take this loan proceed as the fair value. The reason is normally in order to become fair value, there should be interest. But this is an interest-free loan. Now what you can do? By using present value calculation, you can calculate the fair value of this land at the fair value of this particular loan at the beginning of the period. Remember, the reason is why we need to have this to get the fair value, because this is a amortized cost financial asset, and each financial assets liabilities, we know that initially we should measure at the fair value. If you recognize this at 10 million rupees as its fair value, which is wrong. Why? Because that is not the fair value. The reason is this is an interest-free loan. This is not calculated at market participants' point of view. So on that grounds, you want to get the fair value. How you get the fair value? You wanted to get the fair value. Today you are giving the loan, and after 5 years, you are going to receive 10 million, right? Today also you are giving 10 million. After 5 years, you are getting that 5 million back. So what you want to do is, you want to get the fair value by discounting that loan proceed using the discounting factor given in the question. So if you read the question, you can see, question says, on the initial recognition, the market rate of interest for the similar 5-year loan with payment of interest had a rate of 10%. You can normally market එකෙන් ගත්තොත් මේ වගේ loan එකක් දෙද්දි 10%ට තමයි loan එක දෙන්නේ. So you need to take that market interest rate and get the present value of this financial asset. So what you want to do? You want to discount this by the discounting factor of 10%. So which means 1 plus r to the power of n. So this is the discounting factor. So here instead of r, you need to apply 10%. So 1.1 to the power of. So this will be the formula. So now using this formula, you want to get the present value of this 10 million as at the first date, right? So you can write it down. This loan should be classified as amortized cost. This loan should be classified as amortized cost as at 1st April 2016. You need to classify this as a amortized cost financial asset as at 1st April 2016. So get the present value and show. You want to get the present value of this. You want to get the present value. How you get the present value? You are taking this 10 million loan, multiply by 1 over 1 plus r, which is 1.1 to the power of 5. How much is that? Is it 6 million 209,000 230? Is it the amount you got? This is the fair value. This is how you want to get the fair value, by using the market interest rate. Because you know that no one is giving loans at interest free. So using the market interest rate, you want to get the present value of those future cash flows. Then you get the present value, which you have to consider as the fair value at the initial recognition. That is done. Then you can continue in writing. Therefore, initial loan value, therefore initial loan value should equal to its fair value of initial fair value, or you can say that the loan's initial fair value should be the present value of future payments. Initial fair value should be the present value of the future payments of rupees 10 million, using the the payment present value of the future payment of 10 million, using the market rate of interest for similar loan. That is using 10%. 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 Right. So this is the value that we arrived in. Okay. Then what we should do? How to recognize uh, the future periods? Now you have initially recognized this thing. මෙහෙම නෙවෙන්නේ. දැන් ඔන්නවට ප්‍රශ්නයක් එන්න පුළුවන් මේ. දැන් ඔයා බලනවා මේ loan එක දුන්න වෙලාවේ, right, by the time when you give the loan, you credit your cash book 10 million. Correct? And normally you should debit amortized cost account $10 million. Then only the double entry works, no? But remember, now you can recognize this amortized cost liability at 6,209,230. 6,209,230. So that is the amount that you can recognize it. Right, so you credit 10 million here and you debit 6.209,230 million here. Where you recognize the balance amount? Balance amount comes the balance 3.7 million with. Where you recognize that balance amount? You should not recognize that as a financial asset. You can recognize only 6.6,209 as the financial asset, not the balance part. What you should do for the balance part? You have to recognize that as an expense in P&L. Okay, right, okay, write down. The difference of rupees 3,790,787. 3,790,787. Within bracket, write down 10 million minus 6,209,230. How you got that difference? Should be recognized as an expense. Should be recognized as an expense in P&L. Should be recognized as an expense in P&L. Then write down a small topic called subsequent measurement. Subsequent measurement. How you subsequently recognize this? That amortization schedule we need to take. Amortization schedule that you need to take. So you can take, this is in years. Now we are at year 1. No? So you can take amortized cost at beginning of the period, which we calculated 6,209,213. That is at the beginning of the period. Then you recognize this as interest income. Using the same discounted rate. How much it comes then? 620,921. There's no interest to be received, then you can take amortized cost at the end of the period. Amortized cost at end of the period, how much? You need to add this 6,209 plus 620,921. which become 6,838,000 30,340. So what you should do for this part, you want to recognize this as an interest income during the second period. Can you remember what we did earlier? ඉස්සලම අපි ගත්තේ 10 million එක අරගෙන 10 million එකේ present value එක ගත්තා නේද? How much it becomes 6,209,000. We recognize that as a financial asset. And balance 3 million we charge to the P&L as an expense, that is at the beginning of the period. Then we have this amortized cost at the beginning of the period, 6,209,230. So using 10% discounting factor, you unwind this and recognize 620,921 as interest income. Right? Interest income. So likewise, you evolve this for 5 years, then that balance will again reach to 10 million. By that time, you receive the 10 million, then that account is zero. So that's how you want to recognize the interest income and that particular financial asset. Hope you understood. Part 1 is done. Part 2. On 1st April 2016, Pay Limited purchased 1,000 shares of XYZ PLC at rupees 100 per share. The quoted price on the date of purchase, that is the quoted price available at the market on the date of purchase, and classified them as fair value through OCI. We'll make it change. Fair value through OCI. It has to be fair value through OCI. See, this is past papers. Earlier standard, it was classified as fair value through OCI. It was earlier classified as available for sale, but now we know that we don't have that sort of a classification. Now we have it as a fair value through OCI. Right? When you read the past papers, you can see there are some questions given in those past papers with the previous names of the standard terms, right? But time to time, those have been changed. But anyway, it's available for sale financial asset earlier. Now we can call it as amortized cost financial. Sorry, fair value through OCI financial asset. So they have purchased this 1,000 number of shares at 100 rupee per share. Purchase commission of 2 per share was also payable. At the end of 31st March 2017, the quoted market price per share was 105. If the assets were to be sold, commission of O per share would be payable. Required. Advise the management on pay on the following. The initial recognition value of a share at 1st April 2016. Initial value of a share at 1st April 2016. How much should it be? Because this is a fair value through OCI financial asset, they should recognize the asset initially at the fair value. Also plus the transaction cost. Right? Therefore, how much would be the share price value as of this date? It should be the total of this. The price per share is 100 plus 2, 102 per share. That is including this transaction cost, because we know if it is a fair value through OCI financial asset, we should add the transaction cost also as a part of the initial cost, fair value. So that is the answer for the first round. It should be 102,000. Second one, value per share that should be recognized as at 31st March 2017, right? At the end of the period, what you should do? This is a fair value through OCI financial asset. Initial measurement is also at fair value. subsequent measurement is also at the fair value. So subsequently also you need to recognize that at the fair value. So how much is going to be the subsequent share price value? That is 105. You should not take this 4 rupee price because it doesn't say you to take the fair value less cost to sell. The standard say you to take the fair value of the assets, not the fair value less cost to sell. To make you complicated, they have given the commission expenses also. Don't take that because we know that subsequent measurement is anyway at the fair value. So fair value is separately given, which is 105 rupee per share. Then you have to tell in part 2, as at 31st March 2017, fair value of the equity instrument shall be considered at rate of 105 without considering this 4 rupee commission charge. Right. Third one, accounting treatment on fair value difference of the above. What you should do, there is a change. Neither initial measurement is at rupees 102, subsequent measurement is 105. So there's a 3 rupee where you should recognize this 3 rupee gain in the other comprehensive income. So you want to tell in your answer the difference between opening and closing fair value should be recognized as the difference between opening and closing fair value should be recognized as fair value gain in the other comprehensive income. Fair value gain on the other comprehensive income. Where you should recognize that other comprehensive income. Somewhere comes around 3 per share. Neither. The gain opening 103, the closing is 100 and opening 102, the closing is 105. 3 per share again. Right. And there's another small part which gives you 2 marks. Assume that fair value of the above asset has declined as at 31st March 2017 and there has been objective evidence of impairment of the asset. Explain the accounting treatment if the asset was impaired on 31st March 2017. What you should do? We learn this. Now what happened? There was the impairment. We discussed about this, right? When it comes to the impairment, how we should recognize the impairment in relation to the fair value through OCI financial instruments, where you should recognize. Now, under the second part, we learned, third part, under the third section, we discussed where we should recognize this gain or loss. We know that this gain should recognize not in the P&L section, we have to recognize this in the other comprehensive income section. Now you classify this or you transfer this to the OCI as a gain. Assume that this entire asset become idle and it is subject to an impairment. If it is subject to an impairment, how you should recognize it? Where you recognize the gain, you recognize this gain in the other comprehensive income. So impairment you should recognize also in the other comprehensive income. From other comprehensive income to retained earning, you need to transfer them. Understood? Where you recognize that the gain, it is in the other comprehensive income. Ne මොකද කරේ දැන් ඔය අපි 102 වලට ගත්ත share එකක් 105 වෙලා තියෙන්නේ. එතකොට 3 rupee gain එකක් ආවා අපිට. ඒ gain එක අපි කොහෙද recognize කරගත්තේ? Other comprehensive income එක. Because this is a fair value through OCI financial instrument. දැන් ඒක තියෙන්නේ other comprehensive income. කොහෙද other comprehensive income එක තියෙන්නේ? Changes in equity එකේ නේද? Right, if you go to the changes in equity, right? If you go to the changes in equity, if you go into the statement of changes in equity, right? You have description here, stated capital, then you have other reserves, and we'll take other component of income, other component of equity. Then you have retained earnings also. Now when you recognize that entry, where you normally recognize that? කොහොමද ඔයක recognize කරගත්තේ? Now earlier, when it comes to the opening balance, the asset balance was 102 and that has increased to 105. So you identify that there is a 3 rupee gain, 3 rupee into 1000 shares, in the sense 3000 shares. So how you put the double entry? You debit the asset account 3000 and credit fair value gain. You recognize that in this other comprehensive income, right? Under other comprehensive income, you recognize these three. Other comprehensive income වල දාලා මෙතන equity එකට තමයි යාව අරගෙන ඉන්නේ 3000. දැන් යා ඉන්නේ equity එක ඇතුලේ. දැන් මෙයා impair වුණොත්, that is the part, the next part of the question. මෙයා impair වුණොත් මොකද කරන්නේ? Standard එක කියනවා. මෙයා impair වුණොත් මෙයාව අයින් කරලා transfer that amount to the retained earnings. If there is an impairment of equity instrument, which classified as fair value through OCL, this is how you want to classify. From other component of equity to retained earning, you need to transfer. So that is the answer for the final part. Okay, quickly write down decline in the fair value, decline in the fair value fair value gain of rupees 3000 fair value gain of rupees 3000 should be recognized in the other comprehensive income and as there is a objective evidence that the asset is impaired, the cumulative loss directly in the other comprehensive income, and as there's objective evidence that asset is impaired, the total loss and there is a objective evidence that asset is impaired, the cumulative loss that had been recognized directly in other comprehensive income directly in the other comprehensive income should be reclassified from equity and should be recognized in profit or loss through the retained earnings. Through the retained earnings. ඇත්තටම අපි කරන්නේ මේක මෙහෙට transfer කළා දාන්න. Through the retained earnings. So this is how you need to recognize. Okay. Right. So we have done this question number 3 නේද? නෑ, sorry, this one. Question number 3 in June 2017. We are not going to do the other part of that question. Okay, right. Then we'll move to December 2017. December 17. December 2017, question number 2A. This is also looks like a similar question, but it is a small and medium-sized enterprises question. There's no change, don't worry. There's no change. No change in the sense the same theory will be applicable for the small and medium-sized entities also. So nothing to be worried. Right. Read that. Zena Private Limited prepares its financial statement in accordance with Sri Lanka accounting standard for medium-sized entities. Zena has chosen the provision of the relevant section in SLFRS for SME in full, its accounting policy for all the financial statements. The following transaction took place during the year during the financial year ended 31st March 2017. Right, there are two transactions. First one, on 1st December 2016, an interest-free loan of 5 million was granted to its related company, which is payable in 1 year. The market rate of interest of similar loan is 10%. So what they have done is they have given a similar loan, right? Related party company එකකට loan එකක් දීලා. Right, related party company එකකට loan එකක් දීලා. අර ඉස්සල වගේම තමයි interest free loan එකක්. So it is they have a financial right to receive cash in future. So you can consider this as a financial asset, amortized cost financial asset, but only thing is they have given this on interest free loan. So you can't consider this 5 million loan amount as the fair value because it is not its fair value because this is an interest free loan. We know that normally interest free loans, there are no interest free loans. If you are going to take that from the bank, there are no interest free loans, right? So you have to take it from a related. That's why they are giving this as an interest free loan. The market rate of interest for the similar loan is 10%. There is first one. Part 2. On 1st January 2017, Zena purchased non-convertible preference shares of MENA PLC for 2 million. These shares are not publicly traded. Right? They have taken some other shares. Those shares are also not publicly traded for that uh, which means there will be issues in related to getting the fair values. Correct? Right. So those are the two issues that we have. Now we'll look at the required part. Advise the management of Xena on the accounting treatment for 1 and 2 above in their books of accounts. At initial recognition and subsequently as at the reporting period ended 31st March 2017, Xena is a subsidiary of Gold Private Limited and has transaction with Gold. The subsidiary Xena has investment in associate and has receivable balance from the associate which partially impaired. State food disclosures are right. Okay, so that is not relevant for us. We want to relevant the part A of this. Advise the management of Xena on the accounting treatment for 1 and 2 above in their books of account at initial recognition and subsequently as at the reporting period 31st March 2017. Right. Tell me what is the treatment for the first one? Yes, tell me. Now here also the same theory what we discussed under the previous.
This loan is also has given on interest free. Doesn't matter whether this is a fair the full SLFRS or SLFRS for SME. In both methods, the same theory will be applicable. In first case,
Here also the same නේ. පරණ එක වගේම තමයි නේ. ඇයි ඉන්ට්‍රස්ට් ෆ්‍රී ලෝන් එකක් දීලා තියෙන්නේ. එතකොට අපි මේකට ෆෙයා වැලියු එක ගන්න ඕනේ. මොකද කරන්නේ? ඉනිෂියල් මෙෂර්මන්ට් කරන්න මාකට් රේට් එකකින් මේක අපි ඩිවයිඩ් කරලා ගන්නවා නේ. Since the loan is not granted at the market rate, we have to measure the present value of the future cash flows. Discount using the similar interest rate applicable for the loans. නේද? එහෙමනේ අපි ගන්න ඕනේ. මොකද රීසන් එක තමයි මේක interest free loan එකක් වුණාට normal interest free loans හම්බෙන්නේ නැහැ. එතකොට මේක fair value එකක් විදියට ගන්න බෑ. So how you want to take? You want to consider initial measurement as the fair value. That is 5 million. You want to divide by 1.1 million. This is 1 year loan නේ. එක අවුරුද්දක loan එක අවුරුද්දක් නේ දෙන්නේ. So how you get the present value? In your answer, you can write down this way. We'll write the answer and move. As the intercompany loan has granted, as the intercompany loan has not granted, we'll write it like that. As the intercompany loan has not granted at market interest rate, at market interest rates, this cannot be considered as its fair value. This cannot be considered as its fair value. Its fair value. Therefore, therefore, fair value should be arrived. Fair value should be arrived using the present value of using the present value of using the present value of future cash flows, future cash flows, future cash flows discounted, discounted at market rate of interest. At market rate of interest. At market rate of interest. The difference between the difference between the loan proceed, the difference between the loan proceed, the difference between the loan proceed and present value of cash flows, present value of cash flows should be recognized as should be recognized as an expense. අපි ඉස්සල්ලා එකෙත් කරේ අර 3 million ගානක් නේද? As an expense. As an expense. So how you can take the initial measurement? We'll take initial measurement how you get the initial measurement? We have given 5 million loan. This 5 million loan you should divide by 1.1. Then you are getting the present value as 4,545,454. How you got this fair value? You divide 5 million by 1.1. Then continue writing. Difference of rupees 454 546. Within bracket write down 5 million minus 4,545,454. Should recognize as finance cost. Coming to the next line. Subsequently, loan should be amortized using effective interest rate of 10%. Unwinding up your ඉස්සලා හැදුවේ ඒ වගේම තමයි. I'm not taking time to explain since we have done this. Using effective interest rate. using effective interest rates. Amortize, how much is the finance cost for the period? Finance cost for the period is going to be finance cost 4,545,454 into 10%. So this is going to be the finance cost. But remember, when we have taken this loan, on 1st December 2016, our year ends on 31st March 2017. So you want to take 4 over 12 months. This is the finance cost, amortized cost. 156, 51,000, 156, 560, sorry. 560. 560. Right, so that is going to be the finance cost. Then finance cost in the sense for the interest income. Sorry, with the finance cost can interest income. Sorry, it should be interest income. P&L එකට charge කරානේ cost එක මේක interest income. අපි loan එකක් දීලානේ. So then that will be interest income for us. Then amortized cost as at 31st March 2017. Next slide. Amortized cost as at 31st March 2018. Amortized cost as at 31st March 2018 will be get the total of that. 4,545,454 plus 156,560. That becomes 4,696,907. Right. Okay. Now look at the part 2. On 1st January 2017, Sina purchased non-convertible preference shares of Meena PLC for 2 million. These shares are not publicly traded. This is a SLFRS for SME organization එකක් නේද? දැන් මේකට publicly traded වෙන shares නේද? Publicly trade වෙන්නේ නැහැ. එතකොට SME organization එකට standard එක කියනවා if you want to spend more cost and time on finding how much is the fair value, if you want to, we call it, if there's any undue cost and effort, don't spend money to find out fair values, go with the cost. Cost එකම fair value එක විදිහට ගන්න. හැබැයි ඔයාට පුළුවන් fair value එක හොයාගන්න without any cost or effort, go with that price. Now here it says on 1st January 2017, Sina purchased non-convertible preference shares of Meena PLC 2 million. These shares are not publicly traded, which means the cost cannot be, the fair value cannot be taken. So you can measure these shares as its cost. This is specifically for a SME organization, right? Okay, write down.
Non-convertible preference shares, non-convertible preference shares should be measured initially at should be measured initially at
transaction cost of rupees 2 million. Transaction cost of rupees 2 million.
as there is no publicly traded market as there is no publicly traded market as there is no publicly traded market subsequent measurement subsequent measurement subsequent measurement should should be carried at the same cost.
Unless, remember to put this word because this is a very common word you can find in the SME book. Unless, write this, unless the fair value can be measured without undue cost or effort. Unless the fair value of the, unless the fair value of, fair value and, sorry, unless the fair value can be measured, unless the fair value can be measured without undue cost or effort. Without undue cost or effort. That means if you can easily find it out, find it by using whatever the way, but if not, don't try it. In the same paper, we have question number 4. We'll do that and take a small break. Right. Question number 4. Well Private Limited acquired 100,000 quoted shares of a complex PLC for 2 million rupees on 1st April 2016. The shares were classified as fair value through OCI. Well's year end is 31st March. On 25th March 2017, Complex PLC declared a dividend of 1.5 per share. As at 31st March 2017, the market price of a share XD is amounted to 21 per share. Wealth received the dividend payment on 10th April 2017. Prepare the financial statement extract on the above information in the books of Wealth for the year ended 31st March 2017. So what you want to show is the financial statement extracts. So this is a fair value through OCI financial asset. They have purchased these shares by spending 2 million rupees. Right, so initially by the time they purchase, these are quoted shares, right? So they have purchased this 100,000 shares, right? Purchase these 100,000 shares, quoted equity shares, by spending 2 million, which means one share should have been 20 rupee. One share price is 20 rupees. And also they have received 20 rupee, the 20 rupee. Then they have received 150 dividend. And year in price is 21 rupee. You know that there is a new word, I think sometime you would have heard or not, ex-due. What do you mean by this ex-due? What is the opposite of the ex-due? Cum due. That is with dividend and without dividend. In simple form, assume that you purchase John Keel's holding share. Today you pay 200 rupee and purchase it. What is the date today? We'll see it's 11th June. You purchase a share of John Keel's by spending 200 rupee. We'll say John Keel's are paying or is paying dividend on each year end. We'll say their year end is 31st December, calendar year. 31st December, they normally pay dividend, that is their practice. Since John Keel's holding is a PLC, when these shares are trading in the market towards the end of the year, market prices are increasing. The reason is investors know if you purchase these shares towards to the end of the year, definitely you will get dividend income because normally John Keel's declares a dividends in December. Therefore, demand for the share increases. Because of that, the share prices are also going up. We'll see it's going up to 250 rupees because towards to the end of the financial year, this 250 includes dividend portion as well. So we call this as cum due, with dividends price. What will happen soon after the year end, or 1st or 2nd of January? Again, the prices are going down. The reason is no purpose to keep the shares unless there is a real capital gain. Why? They have paid the dividend in last or back in 2 days. Now this share price go down to, we'll say, 245. Why? There is no dividend. If you purchase these shares today, you need to keep the share for the until next year, 31st, or until to the end of the year to get the dividends. Therefore, that price is decreasing. So you call it as ex-due, excluding dividends. Normally, we are using this ex-due to value the shares. Understood? That is the difference between this ex-due and the cum due. Right. Now read the question. දැන් ඒගොල්ලෝ මොකද කරලා තියෙන්නේ? මේ shares අරගෙන තියෙනවා. share එකක් අරගෙන තියෙන්නේ කීය ගානේද? 21 rupee එක ගානේ. Right? 21 rupee per share. So they have received dividend of 150, and at the year end, they are saying that their price, ex-due price, is 21 rupee per share. Now we want to show the financial statement extracts. Right? We want to show the financial statement extracts. What are the financial statement extract we can show? We can show statement of right? We can show the statement of PNL and other comprehensive income. That is one. There, what we can show during the period we have received dividend, dividend income. How much in the dividend? Per dividend is 1.5. So 1.5 into we purchase 100,000 shares. We got the 100,000 shares. So 100,000 into 150 in the sense 150,000 shares dividend income. Then under the other comprehensive income, you can show this is what? This is a fair value through OCI financial asset, right? Equity shares classified as fair value through OCI. So you can take this difference, the changes in the, because they have purchased that for 20 rupee per share. Today price is 21 per share. That means the fair value gain is 1 rupee. So 1 rupee into 100,000, 100,000. That you can show under the fair value gain. How much that is? 100,000. Fair value gain is 100,000. It is 100,000. Fair value gain is 100,000. Then in the statement of financial position, but you can see, you can show fair value through OCI financial asset. OCI financial asset. අපි ගාව තියෙන්නේ එතකොට කොච්චරද shares තියෙන 100,000 ඒකේ value එක වෙන්නේ 2.1 billion වෙනවා දැන්. Why the closing balance is 20. And also you can say under the other receivables you have dividend receivable එකක් තියෙනවා. මේ සාමාන්‍ය dividend හම්බෙලා තියෙන්නේ පස්සේනේ. Dividend receivable එකක් තියෙනවා 150,000. So those are the financial statement extract you can show. Right? That is the answer for part 1. Neither. Okay. Part 2. Alloy PLC issued 600,000 convertible bond on 1st March 2017. These bonds have a 3-year term and were issued at par with a face value of 100 par per bond, which will the fair value. The convertible bonds are redeemable at par. Interest is payable annually in arrears at a nominal interest rate of 8%. Each 100 nominal bond is convertible at any time up to maturity of 25 ordinary shares. When the bond were issued, the prevailing market interest rate for similar debt without the conversion option was 10%. Assess the liability and equity component of the above instrument at the initial recognition. So we have learned about this. We call this as a compound financial instrument. This includes both the equity part and a debt part, right? Under LKS 32, we want to split it into two parts. One is the equity component, the other one is the debt component. How you can get uh, the debt component? First of all, you want to take the debt component, and then from the nominal value you are splitting the uh, debt value, then your equity value will be remain. Shall we try to split that and calculate, assess the liability and equity components of the above? Right. So how we want to split it? එක අපි ගණන් කීපයක්ම කරලා තියෙනවා නේද? ටියුට් එකේ වීඩියෝ එකේ, so you can get the idea from there even if you cannot understand. Right, under that we'll write down. First of all, you want to get the present value of principal repayment. In 3 years. How much is that? It's issued 600 convertible bond on 1st March. These bonds have 3-year term, issued at par with the face value of 100 per bond. So you have 100 rupee per bond share multiplied by 600,000 bonds. So this will be the future value, right? That is going to be 60 million, isn't it? So what you want to do is you want to take the present value of this 60 million, which means question has given you the prevailing market rate of similar bond without the conversion option, that is 10%. So you divide this by 10%, 1.1 to the power of 3, then you get the present value of the cash flows, which come 45 million 078 888. That is the present value of the principal. Then we want to take the present value of interest. How much of interest you are getting? It is 3-year bond, neither 3-year bond. So it is a 3-year bond. Right, so then you can calculate it on the first year. How much is the interest? 600. Shall we calculate the interest separately? How much is that? It's 6 million, 60 million into what is the interest rate? 8%. Is it 8%? 8%. Then it become 40. 4.8 million, right? 4.8 million. So we'll take in first year you are getting 4.8 million. Second year you are getting interest of 4.8 million. And third year you are getting another 4.8 million. So you discount this by 1 divided by 1 point to the power of 1, 1 divided by 1 point to the power of 2, 1 divided by 1 to the power of 3. Then you can get the present value of these cash flows. Calculate and get the present value. That present value comes around get the present values, right? Get these cash flows and take the present value of these cash flows. It become 7,573,000, 7,573,000. Sorry, not 7 million. Sorry. Give me a minute. I will take the total. 4,363,636 plus 3,966, 942, 3,606, 312. 11,936,000, 11,936,000, 890, 890. So this total become 57,015, 57,015, 57,015, 778, 778. Right? So this is the present value of that liability. හරිද මේන්නේ එයාගේ present value of the liability. Okay. Then you want to compare this with the face value. How much was the face value? Face value of this was 60 million. Difference you want to consider as the equity. Which become 2,984, 2,984, 222. So this is the equity component. So in your answer, the question asks you to separate this liability component and equity component. This is how you want to show in the books. Then that balance will be equal to 60. That is the question required. Right? Okay. So we'll take a break and come. Right. So we'll look at the next question. So we discussed this December 2017 question. June 18 question number 4B. June 18. Right. Read the June 2018 paper. Right. Read this, the part B. Mac Private Limited has issued preference shares to two companies with different features as given below. 1 million preference shares were issued to Private Limited at par, rupees 100 per share. According to the contractual terms, Private Limited has the option to require Mac Private Limited to redeem the shares at par at any time after the issuance. Second one, 500 non-redeemable preference shares were issued to BC Private Limited at par rupees 100,000 per share. According to the contractual terms, distribution, that is dividends, are made to holders at discretion of Mac Private Limited. Analyze whether above should be classified as equity or liability in the financial statement. When you look at the first one, you can see 1,000 preference shares they have issued. And as per this contract, Limited has the option to require MA or Mac Private Limited to redeem the shares at any time. Now, when this the Mac Private Limited has given the option to Private Limited to request at any time, they should ready to pay it back. They should ready to pay or they should ready to redeem these preference shares back to the Private Limited, which means it's create them a financial liability because they have a contractual obligation created. So that's how you want to write the answer. Right, this classification is given in L case 32. So accordingly, you have to tell that this is classification of equity and the liability. So Mac Private Limited has a contractual obligation to settle cash. Right, Mac Private Limited has contractual obligation to settle these preference shares at any given time. This will create obligation to transfer financial assets to Private Limited. Therefore, these shares must be classified as financial liability because there's a contractual obligation. So you need to classify them as financial liability. That is the answer for the first one. Second one, 500 non-redeemable preference shares. Here, what do you mean by this non-redeemable preference shares? Non-redeemable preference shares in this is you don't have present obligation, contractual obligation to pay this back, right? These preference shares are non-redeemable. And distribution in the sense dividend also can be paid at the discretion of the issuer, which means it does not create any obligation to make private limited, so you need to classify them under the equity. It's a very simple one, right? You can take, see, you can take 4 marks to each, right? So which we have discussed in our video as well, right? So that is simple. Then December 2018 question number 3. December 2018 question number 3. Right. We'll read the question number 3. See how easy a question. On 1st April 2017, FinKick PLC issued a bond with the following terms. The bond had a par value of 100 million. The bond has coupon interest rate of 10% and interest is payable annually in arrears. The term of the bond is 4 years. The bond is redeemable on 31st 2021 at a premium of 5%. The issue price of the bond was 97 million. Cost associated with the issue of the bond was 2 million. The effective rate of interest has been calculated as 12.706%. The intention of the company is to hold the bond till maturity. See how straightforward, simple question, right? Identify the components of the finance cost associated with the bond over its lifetime with figures. Recognize how the finance cost identified in A above could be allocated to each accounting period in accordance with the Sri Lanka accounting standard. Assume accounting period ends on 31st March. Outline the reason why effective interest rate method is deemed to be superior of the other methods. Right. So you are getting 10 marks. What you want to tell in the answer, you want to the first thing is you want to identify the component of the finance cost. Easy, ne? Which we have done in our class. Right, what are the components? Because I showed this through an example as well, right? Okay, what are the components that you can find there? Right? Right. As per this example, as per this question, what are the components of the finance cost? Right? What are the components of the finance cost associated? First one, the bond had a par value of 100. Okay. The bond has coupon interest rate of 10%. So this is part of the finance cost, right? So you have coupon interest rate. Coupon interest. that will be a part of our finance cost. Neither. How much is the coupon interest? Value is 400 million. You are getting 10%. Neither. So you have 400 million, sorry, 100 million 100 million into 10% into 4 years. It is 40 million. So we'll say figures in rupees millions, then it becomes 40 million. That is one finance cost. The term of the bond is 4. Okay, the bond is redeemable on 31st May 2021 at a premium of 5%. Now you can see there's a premium. Can you remember the example which we discussed? There we identify this everything and we calculated this EIR using an Excel after taking all this cost, right? So how much is the premium? Premium is 5%, right? Premium is 5%. The 100 million is the face value into 5%. Become 5 million. So you have a 5 million finance cost. Issue price of the bond was 97. 100 million worth of asset you have issued for 97, which means there's a discount. So that is also finance cost. Discount, that is 100 million minus 97 million, which is 3 million. Associated cost of issuing the bond, that is also will be part of your cost. Neither issue cost, issue cost 2 million. So altogether you have 50 million cost. Neither 50 million finance cost is there. You have a total finance cost of 50 million. Okay, total finance cost of 50 million. Right? This is the total finance cost, right? Now, you want to tell how this total finance cost, the part 2 of the, see, this is the part 1. So, you are getting 3 marks for that. Second one, recognize how the finance cost identified in A above could be allocated among each period. For that purpose, we calculate the amortization schedule, is it? Right? Oh. Hold on for a second, something wrong. We have two wickets. Okay, four wickets. Four wickets. Right. Now we'll now we'll see how how we need to recognize this cost, right? How we are going to recognize this cost over the period of 5 years. So that's why we are using the amortized cost method, right? That's why we are using the amortized cost method. So you have this is a 4-year bond, right? So you can take years. And amortized cost at beginning of the period. Then we recognize the finance cost using the effective interest rate of 12.706. EIR is 12.706. Then interest paid interest paid and amortized cost at end. Right. So we know the initially the how we should recognize initially. Initially, you have to recognize that the fair value. So fair value is 97, but there's a issue cost of 2. So you take 97 minus 5, neither, because you right. So we receive cash of 97 because we have issued a bond. අපි බොන්ඩ් එක ඉෂුව කරලා තියෙන. එතකොට අපිට 97 හම්බ වෙනවා cash, and we have expensed 2 million. So initial recognition amount will be fair value minus this is a liability, right? So you have to deduct the cost, the initial cost. So that is 95. Right, that is 95. And finance cost you should measure at 12.706%. So it become 12.07, 12.07, Interest is always paid at 10. The reason is interest we paid at 10. Then closing balance will be 9707. 9707. So that will be the opening balance for the second year, 9707. Top of that, we charge 12.33, 12.33. Then interest paid 10. Closing balance will be 9940. 9940. Then third year opening balance will be 9940. Then again we apply the interest, that is 12.63 minus 10. Then their closing balance will be 102.03, 102.03. Then closing 102.03 into 12.706, that is 12.96 minus 10. Then the closing balance will be 105, because we need to settle with premium of 5. Neither. Right. If you take this total will be equal to 50 million, which is this finance cost. So this is how this finance cost is split among the 4-year period of time. Okay, right. Then part C of the question asks, outline the reasons why effective interest rate methods deemed to be superior. Why this method you refer as a superior method? Because this will be a logical method to allocate the total finance cost proportion to the amortized cost of the instrument, right? Proportion to this outstanding, rather, right? It's a logical method of allocation of the finance cost based on the outstanding balance. Based on this outstanding balance only, these expenses will be recognized. When outstanding balance is increasing, the finance cost is also increasing. There's a logical method, right? It will be a gradually the interest income will be interest expense will be recognized in the financial statement based on the proportion of the amount outstanding and also considering the time period. So that's why we call it as a superior method. So you can write effective interest rate method, effective interest rate method logically charge logically recognize, rather charge, logically recognize interest income or expense, logically charge, logically recognize interest income or expense, interest income or expense interest income or expense based on the outstanding balance over the instrument's tenor, That's why you call it as a superior method than the other methods. Okay. We did December 2018 question number 3 neither. Right. We'll see the question number 7C also. In the same paper, question number 7, part C. Explain how financial asset mentioned in 3 above should be classified as per SLFRS 9 financial instrument. Right. Part C, part 3, neither this one. How you should classify these 3 instruments as per the IFRS 9 or SLFRS 9 classification. First one, portfolio of investment in treasury bonds. Wind PLC hold these bonds to meet capital expenditure and it manage these bonds to collect interest and maturity values. When an opportunity arises, it will sell these bonds to reinvest in financial assets with higher returns. So we discussed this under 2 tests. So you can see now we know that there are 2 models, two tests. One is business model test. The second one is business model test, and the second one is SSPI test. That is called the solely payment of interest and the principal, right? SSPI test, second one. So you can see here in the case of the first one, SSPI test is satisfied. What is their business model? Is it to hold the instrument until maturity? No. The intention is to hold the investment, but if a good capital benefit is arrived, they can sell this in the market. So you have to classify them under the fair value through other comprehensive income, right? Okay. So there you can write the business model is to collect contractual cash flows. Business model is to collect contractual cash flows and also selling them. Business model is to correct the contractual cash flows and selling that. Therefore, This bond should be classified under fair value through OCI as fair value through OCI financial assets. Second one, investment in listed equity shares of different entities. Win PLC manage the overall return on the portfolio by both holding and selling the shares. What is the intention? Investment in listed equity shares of different entities. When PLC manages the overall return of the portfolio by holding and selling them. ඒ කියන්නේ portfolio එකක් තියාගෙන ඉන්නවා. There are a number of investments. Some are keeping, some are selling, right? When you are with a good return, they are selling it. When there's a less return, they are holding it, and when it turns into a good return, they are selling it, right? So technically, it's a fair value through profit or loss equity financial instrument. Okay, write down. These investments do not have the contractual cash flows characteristic, contractual cash flow characteristic, and the business model involving to maximize the overall return by holding and selling them. Therefore, this should be classified as fair value through P&L. Therefore, this should be classified as fair value through P&L. Third one, receivable portfolio. Win PLC is very careful about the recoverability of these receivables and attempts to recover recoverable amounts on the due dates by contacting debtors. This is receivables, right? Receivables in the sense they wanted to keep this until it become due, and they receive the contractual cash flows. So both tests are satisfied. That is, therefore, you can classify them under the amortized cost. Okay. Write down. Business model is to hold. Business model is to hold the receivables until it become due, and they received contractual cash flows, contractual cash flows. Therefore, should classify as amortized cost. Amortized cost. So we did December 2018 question. June 2019. June 2019 question number 3. SLFRS 9 financial instrument largely replace LKS 39 financial instrument recognition and measurement. Differentiate SLFRS 9 from LKS 39 in terms of classification and measurement basis. So we should not spend time on this because this was the case where the like the student got this question when they got this question when this standard was changed, right? So you have not learned the previous standards. No, we should not spend the time because as per the classification now, we learned under the new standard, the classification broadly put into 3 categories: amortized cost, fair value through PNL, and fair value through OCI. But in the previous the previous standard, that classification was into 4 categories. We call one as held to maturity investments, which looks like the amortized cost, and fair value through PNL, that is the same like what we have now, and available for sale. Available for sale in the sense it is again fair value through OCI. And there was another classification called loans and receivable in loans and receivables. So that is also now coming under the amortized cost. So that is the basic difference what it had. So we should not spend time on that. Shall we look at the part B of the question? On 1st April 2018, Animex PLC issued a bond with following terms. The bond has had a par value of 200 million with a term of 5 years. The bond has a coupon interest rate of 12% and interest is payable annually in arrears. Market rate for bonds with similar credit risk was also 12% on the issue date of the MX bonds. The market rate of the bond is based on average weighted prime lending rate called AWPLR of 9.5% plus 2.5% for the credit risk of the company. As at 31st March 2019, AWPLR decreased to 9% and bond with similar credit risk were trading at 11.5%, comprising AWPLR 9 plus 2.5 for the credit risk. However, Animex bond was trading 11.75 comparing AWPLR plus 9 plus 2.75 for credit risk of the company. Rate of credit risk of Animex has increased due to the deterioration of the credit quality of the company as at 31st March 2019. Fair value of the bond as at 31st March 2019 using original credit risk was 203.07, whereas fair value of the bond using the Animex credit risk at 31st March 2019 was rupees 201.53 million. The bond is measured at fair value through profit or loss. Required. Advise the management of Animex on the accounting treatment for 1 and 2 below on their books of accounts. The initial recognition of the above bond and subsequent measurement for the year ended 31st March 2019. Read one more time. Shall we try a simple impairment and come this? Then you will easy to understand because small calculation is there that will make little complicated for the time being. We'll discuss another simple this thing and come. That easy for you, right? Okay. We'll discuss this December 19 question number 3. December 19 question number 3. Right. This will help you to do the impairment simply. Solex PLC is applying SLFRS 9 financial instrument with regard to its financial statements for the year ended 31st March 2019. The following information is related to the collective impairment of its trade debtors. The company follows a simplified approach as per SLFRS 9 financial instrument in determining the impairment provision. Its trade data aging is given in the table below. So you can see uh, the trade receivables debtors. Normally ගත්තොත් debtors ලා age bucket වලට කඩලා තියෙනවා. What are the current this thing? What is the current age and what is the this is the current age and what is 1 to 30 days past due and 31 to 60 days past due and 61 to 90 days past due and over 90 days past due. They have calculated it on that basis. And also they have given what are the debtor outstanding balances, right? Debtor outstanding balances of each aging categories. And PD, probability of default for being over 90 days past due. That is also being given. Solex estimated its default rates in provisions matrix as a product of the probability of default, and loss given default is 5% for respective debtor age buckets. However, company maintains 100% LGD for a debtor of 2 million included in over 90 days past due bucket due to fact that this debtor has been declared bankrupt. Calculate the impairment provision of Solex in relation to the trade debtors as at 31st March 2019. Right. Now you need to calculate the impairment. Okay. Right. So we'll see how we are going to calculate the impairment, right? Because we discussed about that probability of defaults, loss given defaults, right? Okay, read the question. Right. Now we'll see how we are going to work out this. Right. So when you calculate the impairment, right, when you calculate the impairment, we know that when calculating impairment, we have explained this, right? Impairment, you take outstanding balance and multiply this by PD. What do you mean by PD? Probability of default. What is the probability? This outstanding can turn into a default scenario. We take that probability and this is multiplied by LGD. What do you mean by LGD? Loss given default, right? That means the probability of becoming a lost person a default, right? කවුරු හරි loss වුණොත් එයා default වෙන්න තියෙන probability එක and economic factor adjustment. This is not much relevant. We see the now when it comes to the current context, this will be very important. Economic factor adjustment character, because EFA factor will be determined based on the unemployment percentages, economic growth, inflation, and everything, right? That means because you know nowadays this economic factor adjustment will be more powerful because most of the people, they do not have ability to pay the debts because they are not getting enough earnings to survive in day-to-day activities, also survive to for their consumption activities, right? They don't have enough foods, they can't buy because their purchasing power has gone down, right, because of this hyperinflationary situation, right? So given all these factors, this EFA factor will also be a demanding in current context, but in your syllabus this is not much applicable. But remember, when you want to multiply this PD and LGD and calculate the default rate, right? So for your example, we'll calculate it like this way. Now you have this right data aging, right? You have this data aging. What are the data agings you have? You have the current bucket, then you have 1 to 30 days past due, Then you have 31 to 60 past due. Then you have 60 to 31 to 60 past due. 61 to 90 past due over 90. Right? So they have given how much is the probability of default. We'll take this as A. Then they have given LGD. We'll take this as B. Then you have the default rate. You can calculate default rate. A into B, default rate. Then you can take how much is the outstanding balance. And then you can calculate how much is the collective impairment required. So you can get the figures from the question. Probability of default for them 8.53%, 15.79%, 26.32, 47, and here 100%. LGD will be 5%. We have calculated LGD across all the age groups as 5. So now you need to multiply and get the answer. 8.53% multiplied by 5% become 0.43%. 15.79 multiplied by 5% become 0.79%. 26.32 multiplied by 5% become 1.32. 47.0 multiplied by 5% become 2.35. 100% multiplied by 5 become 5%. Then you can take how much is the outstanding balances. That is 160 million, 90 million, 45 million. Go to the question. It says here 160, 90, 45, 35, 50, but specifically they are saying, however, the company maintains 100% LGD for debtor of 2 million included in over 90. Right? This 2 million include, right? 2 million include, out of this 50, there's a 2 million worth of a debtor who is considered as a bankrupt person. So when you are taking the final bucket, now you had the 45 E2, then you can take 35, 45, then 35, then you have 50, but don't take 50, rather you can take 48 million here. Because for them we have to calculate the individual impairment. individual impairment. The reason for individual impairment, because he's a fully bankrupt person, we have to provide 100%. Now you want to multiply this uh, this into this. 160 million multiplied by 0.43, that becomes 0.688. මේව තමයි ප්‍රොවිෂන් හදන. ඉස්සර ඔයාලා කරේ කෙලින්ම 5% 10% bad debt provision එකක් එහෙම නෙවෙයි. දැන් ඔයා ගන්න ඕනේ මේ PD into LGD. එහෙම තමයි ගන්න. අර මං කිව්වා EFA fact එකක් තියෙනවා නම් ඒකත් ගන්න ඕනේ. If they have given a factor called EFA, that EFA factor also have to be taken into this multiplication. From that amount, you multiply the outstanding balance. මේක තමයි අර අපිට ඉස්සර A levels වලදී දුන්න 5% 10% වගේ දැන් එන percentage. Clear? So you have 0.688 million. Then second one, 90 million multiplied by 0.71, that becomes 0.711 million. Third one, 45 million multiplied by 0.594, 0.594, that is 1.32 multiplied by 45 million. Ne? Then next one is 2.35 multiplied by 35 million, that becomes 0.823. Then 48 million multiplied by 5% is 2.4. 2.4. Then you want to take the total of these all together, right? When you take the total of these all together, we call this as the collective impairment. That becomes 5.216. Then you can calculate the total impairment. Individual impairment, you identify that there was a 2 million debtor which is fully bankrupt, and collective impairment is 5.216. Altogether, the total impairment is 7.216. So that is the answer for this question. They asked to calculate impairment provision of the SLFRS in relation to the debtors. So this is the provision that you want to put, 7.216. Okay, right. Okay. So we did this one. We are not going to do this one now, but we have to have this question number 3 in December 15 paper. Go and see December 15. December 15. Question number 3. This no need to spend much time, right? Some financial instrument contains elements of both liability and equity. LKS 32 financial instrument presentation requires segregate these two elements and disclosing them separately. Explain the reason for separately identifying liability and equity element component in the financial instrument. That is part 1 of the question. So you need to tell why the requirement is there to separate. Because the reason is uh, when there is a compound financial instrument, right? It's talking about this compound financials. Some financial instrument contain, normally a compound financial instrument has these two things, which we have discussed. Especially when it comes to this compound financial instrument, it creates a liability for the issuer, and also it creates and given an option to the holder of the bond to convert this instrument into the equity. Right? When it comes to these convertible bonds. Especially the you can write the answer, especially the convertible bonds. When it comes to convertible bonds, such convertible bonds have a financial liability to issuer to settle that in the future, and also option to convert them into number of equity shares in future. Why there is a method to separate this into two categories? Because as per the standard, we consider the residual approach or the residual interest after deducting all the liabilities from total assets as the equity. So to reflect that economic substance from this particular instrument, we classify or measure that debt and the equity component separately. So that is the reason why we are separated into two categories. Second one, Redeem PAC has issued 3-year 6% convertible bond at par with a face value of 100,000 and accumulated total proceeds of 100 million. Each bond is convertible into 100 equity shares at any time up to maturity from the date of the issue. The managing director, right? The managing director is of the view that these bonds should be recognized as a non-current liability. The assistant accountant of the company has performed the following calculations with regard to these bonds. Total of face value to be redeemed in 3 years' time, 100 million. Present value of the total face value of the bond at 10% discount rate. Present value of the interest payable at 6% discount at 10%, that is 14 million. 10% is the prevailing market interest rate for similar debt without the conversion option. Evaluate the managing director's view on recognition of above convertible bonds. Advise Redeem PAC as to how the above bonds should be presented in financial statement based on the calculation given. 2 years after the issue of the bonds, Redeem PAC found that likelihood of exercising the conversion option is very less. Explain whether the presentation is above would change in the third year. Right? Okay, we'll first focus on the first part. Evaluate the managing director's view. So what managing director says, the managing director is in the view that these bonds should be recognized as a non-current liability. He said the entirely this should be classified as a non-current liability. Is it true? No, you can't recognize it like that, you can't accept to the MD's view. Why? You know, this bond has a convertible option. As per LKS 32, when there is an instrument with convert option, we need to split the debt and equity separately, right? So the liability portion you should calculate using the present value of the future cash flows, and using the residual approach you need to calculate the difference as the equity component. So you can't, the as per the standard requirement, the director's view is wrong. So which is which you cannot agree, which you cannot agree, right? So you can't agree for that. Okay. Then part 2, advise redeem PLC how to above bond should be presented in the financial statement. So what you want to do, how you want to present this in the financial statement, that's easy. You take the total of these two, right? You take the total of these two, which becomes 90,052,590, and from 100 you deduct this 90 million. Then the balance become 9,947,410. Then this 90 million you have to recognize as a financial liability, and the balance 9 million you have to recognize as the equity separately in the financial statement. So that is the answer for the next one. Part 3 of the question. Third one is, after 2 years after issuing the bonds, Redeem PLC found that likelihood of the exercising conversion option is very less. මේම අපි නිකම් මේ ක්ලැසිෆයි කරගෙන හිටියට එම වෙන්නේ නැහැ කියලා standard එක කියන. හරි unlikely. It's not standard. This company say it is highly unlikely to exercise somebody this option. Explain whether presentation of the above bonds will be changed in third year. එන්නේ නැහැ කියලා ඔක්කොම liability එකක් විදිහට දානවද කියලා. Answer is no. You should not. Why? Because it is unable to predict the behaviors of the bondholders. Today it may be a different behavior, tomorrow it may be another different behavior. Everything will be determined based on the market factors. Nowadays, it's a good example. During last couple of months, decisions of people were totally changed. Therefore, you should continue of this classification of liability and equity in financial statements for this particular instrument, which you should not reclassify everything into the liability. So therefore you should keep continuing in that classification. Don't change. So that is the answer for part 3. Should not change, because the answer should be investors or the bondholders behavior cannot be predictable, right? Therefore you are not changing the classification pattern. Okay, right. So that is the answer for part 3. So we have 2 questions more to be done. We'll do the questions in the coming classes along with the recent past papers, right? Recent past papers questions also. That I'm doing that because this is very important. That's it.